Okay. You should have two packages in your possession. One's a PowerPoint presentation, and the other is a resource material packet with the forms. So as we start going through the program, we'll be flipping back and forth between those two. I've got a 30-minute presentation for you, and there are 51 slides in this packet, so I can't possibly cover all the slides that you have in front of you. So I'll get through as much as I can, and the rest you can treat as a resource material for a later time. We're going to start with slide 8. And we're going to cover the three main forms, and then we're going to talk about problem-solving options that are available for you, and then we'll get into some frequently asked questions, and then we'll open it up for you folks to ask questions as well. So, slide 8 talks about establishing an ERA, and basically a designating body can establish an ERA without a single person wanting to build a business there. For example, they create an industrial park, they bought 20 acres, and they're going to declare it as an ERA before they've sold the first piece of ground off of that 20-acre industrial park that they've created. So that's one way of creating an ERA. The other way is the more common way. Somebody's established, they have 2.5 acres, they've got a factory there, and they want to improve and grow and enhance the business. So they want that 2.5 acres that they already own designated as an ERA so that they can begin a building project on it. So in that case, they're going to start the process out by filing an SB1 to put in that request. Now, while we're talking about the SB1, we might as well go to our forms packet and get it in front of us. And let's go to page 2 of your resource material packet, and that's going to be page 1 of this SB1. Now, page 1 of the SB1 provides information on the proposed project, estimated cost, estimated jobs created, salaries for those jobs, things like that. That information is on this form. But an important piece of information that's on this form that is commonly overlooked is in section 2, section 2, right-hand side. Estimated start date, estimated completion date. That's a key piece of information because you have to know whether they're talking about a 6-month project or a 5-year project. And maybe that 5-year project has 3 phases to it. So let me give you an example. If somebody has a 6-month project, that's not a hard thing to understand because they're going to start on July 1st and be done by December 1st, and it's going to be assessed the following March 1st assessment date, and it's no problem. But what if somebody says, I've got a $10 million building project, and it's going to be done in 3 phases, where phase 1, I add an addition to my existing building, and I want a tax abatement on that existing building. 2 years from now, I'm going to build a new warehouse, and then 5 years from now, I'm going to build another addition to the building with a new line that I'm hoping to develop and create. So an SB1 could handle a very short-term 6-month period for a specific $1 million warehouse, or it could be 3 phases spread out over a 5-year period. And that's fine if that's what the designating body desires. But I have seen taxpayers who want to do a 5-year, 3-phase project, and the designating body says, well, we would prefer to cover just phase 1 right now, and then down the road when you get ready to build that warehouse, come back to us with another SB1, and then we'll grant you an abatement on that warehouse. And so I have seen it where the designating body says, sure, 5 years, 3 phases, $10 million, that's fantastic, we're going to accept that. And I've seen it where the designating body says, we would really be more comfortable if you just submit an SB1 for phase 1 of this project. And which one of those is wrong? And neither one of them is wrong because the designating body has that kind of a power to make that kind of a request. So neither one of them has done anything wrong with that type of a request. So the SB1 is an estimate that covers jobs and things like that. Now, the reason why the SB1 is so important is because the designating body through the abatement process must determine the totality of the benefits, that those benefits are sufficient enough to justify the deduction. So are there enough jobs being created, and what are the salaries for those jobs, and are there other benefits as well? And so that's part of the abatement process. Now, sometimes a designating body might get a request from a person with a very small project, and they say, well, how many jobs is it going to create? And the gentleman says, well, I was operating out of my garage, and now I want to build a machine shop behind my house, and I'm going to do machine shop work. And they say, well, how many jobs are you going to create? Well, it's just my job, and I've got a son that's a freshman in high school, and 4 years from now it'll all be his. So that's 2 jobs maybe. And so, so the designated body could say, well, just retaining your job isn't really enough to justify this deduction. And the gentleman says, well, you've been giving it to everybody else, so I feel like I'm entitled to it, and I want my piece of the pie too. And so that's an example of where the designating body studies the totality of the benefits and determines whether there's enough benefits there to justify granting the abatement. Now, in my longer course, I talk about a county having 3 designating bodies. And you could have a designating body that handles the county, and then a designating body that handles a little town over here, and then a major cities over here, all within the same county. So in this example, you've got a county with 3 separate designating bodies. Now, those designating bodies act independent of each other. So it's possible that this situation of this one person coming and saying, I want to build a machine shop in my backyard, and right now it's just me, and I don't plan on creating any new jobs. One designating body could say, hey, this is the start of something great, and we want to give it to them. And they process it through. The next designating body says, well, the totality of the benefits just isn't there to justify this deduction, so we're not interested in going through the remainder of the process. Has one of those designating bodies made a mistake? And the answer is no. They were elected to do a job, and they're holding the meeting in a public setting, and they're doing everything in accordance with the law, and part of their duties and responsibilities is to make this kind of a tough call from time to time. So neither designating body is wrong with the way they handle that type of an aspect. So the page 1 is completed. And now let's go to page 2, which is filled out by the designating body. And page 2 of the form is what? On page 3 of your packet. Now the top half of this form, there's been some confusion about it over the years. For example, letter A. Letter A is where the designated area has an expiration date attached to it. And this letter A is there as an option. A lot of times there's no information there because there is no expiration date attached to this abatement. But if a designating body said, well, we want this ERA designation, and an ERA designation is a legal description of the land, it's that 2.5 acres or whatever, and they could say that we want this 2.5 acre ERA designation to expire on December 31st of 2016. So they need to get these building projects done by then, because after that, the designation as an ERA area has expired. And then if they want to build something down the road, they would have to go back and redesignate it. That doesn't happen real often, but people commonly look at letter A and say, well, we give them a 10-year abatement deduction, so I guess the the ERA designation expires in 10 years. And that's not correct. The ERA designation could go on forever and ever and ever until they adopt a resolution to terminate it. And it's separate from them getting a 10-year abatement on this project, and then 3 years later they do that phase 2 project, and they get another 10-year abatement on that as well. Letter B, that's just where you tell whether it's a normal tax abatement or a residentially distressed area. So B1 is the common answer for that. Letter C, the amount of the deduction applicable is limited to. That is frequently left blank, but every now and then a designating body wants to set limits. A taxpayer says, well, I want to put up a $5 million building. And there's an occasional time where a designating body says, well, if you're putting up a $5 million building, we'll limit you to $5 million. And then if the assessed value of the building turns out to be $4.8 million, they'll get the $4.8 million because that's the actual assessed value of the investment. But if the assessed value turned out to be $5.2 million, then they would be limited to that $5 million limit that the designating body placed on them. Other limitations or conditions. Every now and then you get a designating body that wants to put other terms or conditions. For example, maybe they would say, we expect you to be current with your taxes. If you become delinquent in your taxes, we're no longer going to approve your abatement deductions. Because that was a problem in some counties where they were 2 and 3 years delinquent in their taxes, and we're still getting tax abatement deductions every year. And there's nothing against the law about getting a tax abatement deduction while you have delinquent taxes, but apparently it rubbed some designating bodies the wrong way, and they felt strongly enough to put that kind of a language into their resolution. Another example of language that could be added to the resolution is if you move this business out of this jurisdiction within this 10-year abatement cycle, we want your tax savings refunded back to us. So after 6 or 7 years, they shut down the plant, moved the jobs to Mexico. The company could invoke this clause and say, well, you have saved X amount of dollars over the years, and now you're moving these jobs to Mexico, so we expect a refund of those taxes. And that's an example of something that could be added there. Another example that, of something that could be there ties to a question that was asked just before the class. How about administrative fees for the legal ads and the cost of the lawyer to draw up the resolutions and things like that? This county auditor that submitted this question didn't think it was fair for the taxpayers to foot the bill for these kind of administrative expenses related to the abatement process. And Indiana Code 6-1.1-12-2, letter H, talks about a one-time filing fee to defray those costs. And so if a county wanted to impose that kind of a fee, that one-time filing fee, that would be something listed as a term or a condition of the resolution. And so those are some examples of limitations and conditions that could be added to a resolution. A lot of times they're not there, and that's fine. But if the designating body desires them to be there, they have the right to create those kind of limitations and conditions. Letter E, that's simply where the designating body is giving somebody a 1 through 10-year abatement deduction, and that lets the county auditor know which table of deduction percentages to use. Letter F is a new addition to the form, and that's because as of July 1st of 2013, the statutory abatement deduction percentages no longer exist in the Indiana codes. And so for an abatement deduction where the SB1 was approved before July the 1st, the Indiana codes contains percentages for those. And for abatement deductions given July 1st and after, no such percentages exist anymore, so it's up to the designating body to create that set of percentages. Now, a frequently asked question we get on that is, well, what if the designating body fails to do that? Should I just go to the Indiana code and use those old percentages that were established? And the answer is no. For abatements approved after July 1st of 2013, no such percentages exist, and you really need to kick it back to the designating body and tell them before you can grant this deduction, they're going to have to correct that resolution and adopt a set of percentages to be given to those abatement deductions. And so that's an explanation on letter F. The abatement deduction, if you want to go to page 1 of your packet, there's the set of percentages. And you can see there's a set of percentages for real property, a set of percentages for personal property, and then it explains where you can find in the Indiana Code to find that terminology for abatements granted after June 30th of 2013. So basically, the designating body is going to establish that set of percentages on the following factors. They're going to look at the total amount of the investment. They're going to look at how many jobs are being created. They're going to look at the wages or salaries being paid. And they're going to look at infrastructure requirements. Sometimes somebody comes in and says, we just bought this 10-acre plot and we're going to build a big building, going to create a lot of jobs for you, but we need some help from you. There's not enough electrical out there, so we're going to have you enhance the electrical power substation out there, add a few more transformers or whatever. We're going to need roads built back through there, and we need water lines and sewer lines. And so that kind of a request is something the designating body has to consider on, do we want to give them an abatement with these kind of terms and conditions attached? How much do we want to pay? How much should we ask them to pay? And does this affect the type of abatement deduction percentages that we're going to give? So that's all a part of that approval process. This is the Indiana code that talks about abatement deductions of June 30th and before and July 1st of after. And so we've already talked enough about that. Unauthorized facilities is an important concept to understand. And basically, the Indiana Code says that the following facilities are not authorized to receive a deduction: golf courses, country clubs, massage parlors, tennis clubs, skating facilities, handball or racquetball facilities, hot tub facilities, suntan facilities, racetracks, any facility that is a primary purpose of retail food and beverage, automobiles, sales, or service, and other retail, and then there's that big word, unless. Unless an economic development target area is established per 12.1-7. And then it goes on to say that residential facilities may not be approved unless the multifamily, it's a multifamily with at least 20% of the units are used for low to moderate income, or it's in an economic development target area, or it's designated as a residentially distressed area. And then the final thing that is an unauthorized facility is the packaged liquor store. If you want to see an actual copy of that statute, I included it in your packet this year, and you can just put a note that it's on page 8 of your packet. But that's pretty much what the statute says. Filing requirements. Okay, the CF1 is the next form that we're going to talk about. And let's get the CF1 in front of us, and that's on pages 4 and 5 of your packet. Okay, so the CF1 is filed with the designating body and the county auditor. Each year, an abatement deduction is requested, and it must be filed between March 1st and May the 15th, or an approved extension date. The major difference between the SB1 and the CF1 is that the SB1 is an estimate of the project before it begins, while the CF1 is an actual report of what happened after the building was completed. And that's an important concept to understand. One is an estimate before the fact, and one is one is after the project is complete. Sometimes people will say, well, they promised us a $5 million building and they only built a $4 million building, and they promised us 50 new jobs and they only gave us 45 or 25 or whatever. And we have to remember that one was an estimate and the other was an actual report. So let's see. So here's a frequently asked question. Should the CF1 be signed and approved by the designating body before the real property deduction is allowed? And let's go to page 5 of your packet, which is page 2 of the form CF1. Indiana Code 6-1.1-12.1-5.9b states that the designating body may determine whether a property owner is in substantial compliance within 45 days. So it's possible that the designating body will receive this CF1, not review it within the 45 days, and therefore it's not checkmarked as compliant or non-compliant, and it's not signed. And every now and then I get a county assessor for personal property or a county auditor for real property that says, I will not process that abatement deduction until I have a signed copy in my possession. And I have to tell the auditor, well, you're overstepping your bounds there, because it's up to the designating body to review this form, make a determination, and sign off on it if they desire to. So basically, if this form goes 45 days untouched, isn't signed or completed by the designating body, then it's assumed that it is compliant, okay? Now, another frequently asked, I think it's coming up, so I'm jumping ahead. And I've got my cell phone on, and I need to turn it off, too. I'm sitting up here worried that my phone's going to start ringing on me up here. So let me take care of that. There. So the next frequently asked question, if the CF1 is not filed by the taxpayer, who makes the decision that they're not in compliant? Now, I just said that the designating body has the authority to determine compliance or not. But that is once the CF1 has been filed. If the CF1 has not been filed, then how can they do that next step to determine whether it's compliant or not? So the answer to this question is that there are two types of compliance. There's the statutory requirement that they submit the form, and then there's the process of approving that CF1 once received. So, a county auditor could deny a tax abatement deduction if a CF1 is not filed. Later on the program, we get into the problem-solving aspect and how things like this can get corrected. So there is a way of correcting this type of defect, and we'll get into that later on in the program. But right up front, the auditor has the authority to make that kind of a determination that they failed to file the CF1, and that's not in compliance with the statutes. Therefore, I'm not going to grant their deduction. And if you need to see a memo on that particular issue, we issued a frequently asked questions memo from this conference back in 2012, and you can actually see an official answer in memorandum form on that, plus you've got this slide if somebody needed to see it in writing. And here's a new section that we've added to the program. It concerns annexations. We get calls all the time that the city re-annexed, took land away from the county. Does that make an abatement that was given within this area null and void because the city didn't approve it? So does that automatically make it null and void? Who improves future abatements, things like that? So we added a few slides to help you out with the annexation process. And first, the abatement is not affected and continues as business as usual. The one change is the ERA designation was granted by the appropriate designating body at the time, and it's also important to understand that each assessment year or deduction year stands alone. This means that the appropriate designating body for a particular jurisdiction will process that year's CF1. So that means 3 years ago, the county approved an abatement deduction, and in year 1 they approved the CF1, year 2 they approved the CF1, year 3 they approved the CF1. Now in year 4, reannexation has occurred, and on March 1st of 2014 or 2015 or whatever, that particular year on that particular assessment date, that business is located within the city's jurisdiction, no longer in the county's jurisdiction. So it would then be up to the designating body of that jurisdiction to approve that CF1. That means the city's going to start approving those CF1s through this reannexation process. And so every now and then we get somebody that says, well, I worked with the county to get this established and I don't like the city and they talked gruff to me when I met with them last time or whatever. I want to keep working with the county. But the law is very specific that a designating body handles the affairs within their jurisdiction. And so just because somebody wants to continue working with the county council instead of the city council, that's not in compliance with the rules and regulations and the laws that are on the books. So that covers annexations. Oh, there's a hand up. Yes. The question is, for the folks on the other side of the room, does the city have to grandfather it in? And the answer is they would have to review that SB1 and determine, are they still meeting the promises and estimates made when that began? They couldn't simply just say, well, we don't like them, so we're not going to give it to them. They would have to have just cause for doing that. And if they decided through the CF1 approval process that they were no longer in compliance, there's an appeals process where the taxpayer could challenge that. So just because the designating body says we're no longer going to grant you an abatement deduction and we're going to disapprove your CF1, That doesn't have to be the end of it. The taxpayer would have the right to challenge that determination. So there is an appeal process in the codes. So back to your original question, if the city just simply didn't like them and they disagreed with the theories and philosophies of the county council when they approved and granted it, that may not be sufficient to disallow it. Local control prevails on this, so the state would not get involved with that aspect. This would be the local designating body deciding how they want to conduct the affairs of the people, and if the taxpayer disagrees with it, there's a mechanism in the statutes that allows for an appeals process to occur. And so it would be at the local level, and we wouldn't give an opinion or anything like that on the matter. Another question we get with, let's see, back to that slide. We need to go to the Form 322. That form starts to talk about the 322, page 6 and 7 of your packet. And in the upper third of the page, instruction number 8, it talks about those facilities that are not that are excluded from receiving tax abatements. So it's on the form and it's Indiana code. Every now and we get somebody that files a tax abatement form. Suppose they build a new house or a garage and it's residential property, and they said, well, you're giving abatements to everybody else, we want ours too. The Indiana code clearly says that a residential property has to meet that low income type stuff or an economic development target area criteria or the residentially distressed. If none of those factors apply to that particular application for a deduction, it should be denied because it's in compliance with the law. Let's see, and I got to get my script caught up. Let's see. And then page 2. Page 2 is where the auditor fills out the deduction. And every now and then we get a taxpayer that fills out, they've gotten a 10-year abatement deduction. It was a $1 million project, and they calculate what their deduction is going to be for each of those 10 years. And so every now and then I get an auditor that looks at that and says, well, they've already calculated it out for the full 10 years, so my work's done for me. And the answer is, no, not really, because your job is to adjust that qualifying investment each and every year. So in year 1, what was the assessed value? They put down $1 million is what they qualified for, but when you get the copy of the property record card, the actual assessed value was $1.2 million. And that $1.2 million was the whole building, and it was in the area, and there were no limitations placed on it on the SB1. So sure enough, they should be getting an abatement deduction for $1.2 million, even though they estimated it to be a $1 million project. So an auditor will ask, well, what do I do? They've already figured it out. And I say, well, cut it out of another form and tape it across the top of it if you want, or copy off a second blank sheet and attach it to it and make your calculations on the second sheet. But the bottom line is you need to make an annual calculation of that deduction. And so 1 year it's a $1.2 million assessment. The next year it goes up to 1.35, and then the next year they file an appeal and get that 1.35 assessment lowered back down to the 1.1. So from year to year to year, that assessment's going up and down, and you will adjust the abatement deduction accordingly. Now, the abatement deduction percentages, there's a list of the percentages on page 2 or page 7 or page 2 of the 322 RE that gives you the percentages that are established by the Indiana Code for those abatements approved June 30th of 2013 and prior. But if they are July 1st, 2013 and after, you're going to have to look up a set of percentages, and that's why there's a blank line there for you to insert the percentages that was approved by the designating body if done after July 1st of 2013. And so that's a frequently asked question we get on that. Let's see. Another important thing to understand about the approval of the 322, and this is on slide 48 of the program later, but somebody's going to cut me off when my half hour is up, and I've lost track of time, so they're going to have to just tell me when to hush up. But on slide 48 of this program, it talks about the importance of getting a property record card. If you don't take anything else from my 30-minute presentation, you need to understand the importance of each year getting a copy of the property record card from the county assessor. And it may be a 10 or 12-page property record card, and maybe it's that new warehouse, and you can flip to page 7 of that property record card, and there's that warehouse all by itself. And year after year after year, you can easily find the assessed value of that warehouse because it's a line item and it's assessed separately. But there are times where they add on to a building, and you had a 10,000 square foot building and they add 5,000 square feet to it, and it's assessed separately on a property record card. The next year it's assessed separately on the property record card, and you can easily track the assessed value of that improvement. But then one day a general reassessment comes around, and the assessor isn't assessing a 40-year-old 10,000 square foot building and that brand new 5,000 square foot building, but the assessor is assessing that 15,000 square foot building as a whole. And the assessment last year was 1.5 million, and this year it went down to 1.1 million, and you're going to have to prorate and allocate the assessed value of the old and the new from last year and apply that percentage to the current year's assessed value. And so that's an important concept to understand. Now I realize that the county auditor is very busy. And another thing that's nice about getting a copy of the property record card is you're highlighting things in yellow, adding machine tapes are added, stapled to it, and you're writing notes all over it. And year after year after year, you can pull those files out and say, I forgot how I did this last year. Oh, here's last year's notes. Oh, now I remember. Here's what I need to do for this year. And it's real helpful to do that. Or maybe you had your second deputy handling tax abatements for you. And after 10 years, she decides to go get another job and she leaves you. And now somebody else has to come in and fill that duty. And what do? Well, now you've got this nice history in the filing cabinet where they can pull out the last 4 years of abatement calculations, and they can kind of get a current property record card and follow through the theory and the formulas and things like that. Now, I've had situations before where the county auditor says, I've got somebody questioning tax abatement deductions for the last 4 years. And I say, well, let's go down to the assessor's office and get copies of those property record cards. And the assessor says, well, we changed software last year, so I can't recreate those cards anymore. And that's kind of left the county auditor hung out to dry because all those calculations on each card from year to year to year are gone and can't be replaced. So that's why it's very important for you to create that history of obtaining a property record card each and every year. So that's the Form 322RE. Now, this form has to be filed by May the 10th or so many days after the Form 11 is sent. And one commonly asked question is, what if no Form 11 is ever sent? Well, then this section of the Indiana Code says that the tax bill would then serve as first notice so they could actually file for the deduction after they get their tax bill. And then the next question is, would that possibly cause shortfalls and things like that? And it depends on if it's a big assessment or a small assessment, but shortfalls would definitely be a consideration. So now let's get into the problem-solving aspect that may arise, because the problem-solving aspect is something that's very important to you folks. I go through this aspect of the codes many, many times throughout the year, and I'm going to slip through a few slides just to speed up things. But basically, the process of correcting errors can happen with an incomplete filing, a late filing, and then what can a particular section of the Indiana Code correct? And Section 11.3 covers some of the different things that the waiver of noncompliance provision can correct. It can correct the failure to submit the SB1 before that hearing with the designating body. It can correct the failure to submit the SB1 before the project begins. There are times where the person bought the 10-acre cornfield, put up a business in it, and during the ribbon cutting ceremony, they said, oh, we should have asked for tax abatement on this. Can they get a tax abatement on a brand new building that they didn't ask for the abatement deduction before they broke ground and started building? And the answer is yes. They can go through this waiver of noncompliance provision, and the designating body would write up their resolution like they normally do and add this clause that they are forgiving them for that mistake that they made. So that's a possibility. Failure to designate the ERA zone before the project begins. I had a company one time that had their 2.5 acres, and the 2.5 acres was an economic revitalization area, no expiration date. They grew and they grew and they grew, so they needed to buy the 1.5 acres adjoining them so they could keep right on growing. And the county auditor said, when the deduction came around, well, that 1.5 acres isn't in an ERA zone, so I can't grant them a deduction. So this waiver of noncompliance provision was a way to retroactively go back, correct that mapping issue, and extend the ERA deduction or designation out for them, and then the deduction could be allowed. So that's an example of waiver of noncompliance and how it's there as a safety net to correct those kind of problems. The designating body is required to make the findings of fact before designating the area. That's hardly ever used. But the next two items are common items. Failure to file a timely application. Bought their 10-acre cornfield, built a big plan in it, jumped through the SB1 and got the resolution, built the building, created the jobs, cut the ribbon, people are working. Building was assessed, nothing was ever done. All of a sudden they get a tax bill in the mail and they say, whoa, wait a minute, I'm supposed to get an abatement on this. 100% in the first year, why am I getting a bill of this size? And they go to the auditor and say, why am I getting a bill this size? And the auditor says, but did you file your Form 322RE? If I don't have it in my files, so can you give me a copy of it if you think you filed it? And let's see if it's file stamped. And the guy says, well, no, I didn't file any form. I thought it was done and over with, and you'd take care of the rest. But the Indiana Code's very clear that if somebody desires to have an abatement deduction, they have to apply for the deduction through the filing of the Form 322. So this can be corrected. The auditor is correct in saying, well, you failed to file the 322, so I'm not giving you a deduction. But then they can go back to the designating body, ask for forgiveness, and then it's possible that they could still get it. Of course, that could cause shortfalls too with that type of scenario. Failure to file a complete application is the next one. And part of the application is year after year after year, they're required to file a CF1. And if an auditor denied their abatement deduction because they failed to file that CF1, this would be a way of saying, okay, your application is not complete this year because you failed to file that CF1. They can do a waiver of noncompliance provision and forgive them for failing to do that and correct that situation. Now the note on here is very important. This process of waiving noncompliance does not give the designating body the authority to grant abatements on assets that don't qualify. Had a mayor one time that said, if you move your company here, we'll give you abatement on everything. Land, that 30-year-old building, and the new improvements that you're going to make. So they applied for the full deduction. The auditor says, no, you can't have the deduction on land, and no, you can't have the deduction on that 30-year-old building, so we're only going to give it to you on the new improvement that actually qualifies. Well, the taxpayer calls the mayor up and says, hey, what's going on here? You promised me abatement on everything. So the mayor calls us and says, isn't there some way we can take care of this? I promised that, and I really got egg on my face. And it's honest. I mean, we should honor I'm the mayor, and I was elected to do a job, and we should honor what I told these people. And our answer is, well, you took an oath to uphold the law, and the law is very clear on this, and you kind of overstepped your bounds on it. And we can't grant a deduction that's in conflict with the Indiana codes, whether it was promised to them or not. And so that's an important concept to understand, that you cannot grant an abatement deduction on things that don't qualify. This slide is on clerical errors and mathematical errors, hardly ever used. That other Indiana code site is where 99% of all the non-compliance issues are taken care of. I don't know how much time I've got left. I think I've went over already. Some of these frequently asked questions, you can just read through here, and the answers are pretty plain and simple.